It's 1944. The world is deep in the costliest conflict in human history. World War II is claiming 70 to 85 million lives. The global economy sits shattered, facing an estimated $15 trillion in damage, adjusted for today. Yet 730 delegates from 44 allied nations gather in the quiet New Hampshire town of Bretton Woods. They are not there to discuss the war. They are there to build the peace. Their mission, to forge a new financial order from the ashes of 2 world wars and a Great Depression. An order that would prevent the economic chaos that led to the conflict, and an order that would crown one currency supreme. After 22 days of intense negotiation, they chose the US dollar. It was pegged to gold at $35 per troy ounce. Every other major currency was then pegged to the dollar. This was the birth of the dollar's global dominance. To understand why that 80-year-old decision now faces its greatest challenge, we have to go back. What does it even mean to be the world reserve currency? It means your money is the default for global trade. It's the currency nations use to pay for oil, for wheat, for microchips. It's what central banks in other countries hold in their vaults as savings. This isn't a title you apply for. You earn it through economic might, military power, and, most importantly, trust. And it's a title that has been passed down through empires for over 500 years. This story isn't new. It's a cycle, repeating over and over. From 1450 to 1640, Portugal's real reigned. Their dominance wasn't just economic. It was built on the back of advanced caravels and mastery of the spice routes to India. They controlled the flow of goods, so they controlled the currency. But empires, and their currencies, eventually fade. As Portugal's naval power waned, Spain's rose. The Spanish Real de Ocho, or Peace of Eight, took over. Its dominance was fueled by a flood of silver, mined from Potosi in modern-day Bolivia. This silver coin became the world's first truly global currency, accepted from the Americas to Asia. Its dominance lasted an impressive 150 years until around 1780. But wars, inflation from too much silver, and economic mismanagement eroded Spain's power. Next came the Dutch. For a brief, powerful period, the Dutch guilder was on top. Amsterdam became the financial center of the world. They invented the first stock market and the first multinational corporation. Their sophisticated financial system, not just military might, secured the guilder's 80-year reign. But costly wars with Britain and France bled the Netherlands dry, which brings us to the British pound sterling. This is the most direct comparison to the US dollar. Beginning around 1815 after the defeat of Napoleon, the pound ruled for 99 years Britain's Industrial Revolution, its sprawling empire covering 25% of the globe, and the powerful Royal Navy secured its place. London was the center of finance, and the gold standard was its anchor. By 1914, a staggering 60% of all global trade was invoiced in sterling. It looked unshakable. But then came World War I. Britain borrowed heavily, spending 41% of its entire GDP on the war effort. It was forced to abandon the gold standard. It emerged from the war victorious, but as a debtor nation, primarily to the United States. World War II finished the job, shattering Britain's economy and its empire. The pound's reign was over. A new power was needed. This brings us back to 1944, and the US dollar's ascent. America's position was unique. While the rest of the world was in ruins, the US mainland was untouched by the war. Its industrial base had doubled in size, producing 50% of the world's manufactured goods. It was the world's creditor, not its debtor. Most importantly, the US held 70% of the world's gold reserves. That's 578 million troy ounces of gold, sitting in vaults like Fort Knox. The dollar was chosen because it was the only currency still credibly backed by, and convertible to, gold. The Bretton Woods Agreement made the dollar as good as gold. Other nations could hold dollars instead of gold, knowing they could exchange them at $35 an ounce. This wasn't just about economic strength, it was about trust. For nearly 3 decades, this system worked. It ushered in an era of unprecedented global growth, known as the post-war boom. Global trade expanded, and economies in Europe and Japan were rebuilt. The dollar was the stable, reliable anchor the world needed. But the system had a fatal flaw, identified by an economist named Robert Triffin. He pointed out a dilemma. The world needed more dollars to finance growing trade. But the U.S. could only supply more dollars by running a trade deficit, sending more money out than it took in. As these dollars piled up overseas, they would eventually outnumber the U.S. gold reserves. At that point, trust would shatter. Triffin was exactly right. Here's where it gets interesting. In the 1960s, the U.S. started spending heavily. President Lyndon B. Johnson financed both the Vietnam War and his Great Society domestic programs. This spending was not paid for with taxes, but by printing more dollars. The U.S. national debt climbed 15% between 1965 and 1970. Other nations, particularly France under Charles de Gaulle, grew suspicious. They saw the U.S. exporting its inflation and paying for its wars with paper money. De Gaulle famously called this the exorbitant privilege. So France did the logical thing. It began demanding gold for its dollars, as promised at Bretton Woods. In 1965, France sent its navy to New York Harbor to collect $150 million in gold. Other nations followed suit. America's gold reserves began to bleed. In 1950, the U.S. held 509 million troy ounces. By 1970, that number had plummeted by 50%, down to just 262 million troy ounces. The U.S. had $107 billion in gold, but foreign nations held over $40 billion in U.S. dollars. The run on gold had begun. By 1971, the writing was on the wall. The U.S. was facing a choice. Either trigger a massive economic depression at home by raising interest rates to defend the dollar, or break its promise to the world. It chose to break the promise. On August 15, 1971, President Richard Nixon appeared on television. He announced he was temporarily suspending the convertibility of the dollar into gold. This Nixon shock was anything but temporary. It unilaterally ripped up the Bretton Woods Agreement. The dollar was no longer backed by gold. It was backed by nothing but the full faith and credit of the United States. It became a pure fiat currency. Many predicted the dollar's immediate collapse. If it wasn't backed by gold, why would anyone hold it? They were wrong. What saved the dollar was not gold, but oil. A deal was forged in secrecy, and it was a masterpiece of geopolitical strategy. In 1973, following the oil embargo that sent prices soaring 350%, the U.S. made a deal. Secretary of State Henry Kissinger flew to Saudi Arabia. The agreement was simple and brilliant. The Saudis, and by extension all of OPEC, would price their oil exclusively in U.S. dollars. This was the petrodollar system. In return, the U.S. would provide military protection and weapon sales to the Saudi kingdom. Think about what this meant. Every nation on earth, whether friend or foe, needed oil. And to buy oil, they now needed U.S. dollars. This created a massive, artificial, and permanent global demand for the dollar. It cemented the dollar's reserve status, not with gold, but with black gold. The dollar's dominance continued, reaching 85% of foreign exchange transactions by 2001. But this new system came with a new, dangerous side effect. America no longer needed to be fiscally responsible. Because the world needed its dollars, the U.S. could run massive trade deficits. It could import real goods, cars from Japan, electronics from China, and pay for them with paper money it printed. From 1976 to 2000, the cumulative U.S. trade deficit surged from $8 billion to $369 billion annually. This meant hundreds of billions of dollars flowed out of the U.S. Countries like China and Japan, flush with these dollars, had to do something with them. They bought the safest asset they knew, U.S. Treasury bonds. They were effectively lending that same money back to America. This fueled America's debt. By 2008, the U.S. national debt stood at $10 trillion. Then came the catalysts for the current crisis. The first was the 2008 global financial crisis. The crash, which started in the U.S. subprime mortgage market, froze the global financial system. The Federal Reserve responded with quantitative easing, or QE. This was a new term for printing money on a massive scale. The Fed's balance sheet exploded from $900 billion in 2008 to $45 trillion by 2014. The national debt, under President Obama, skyrocketed, reaching $19 trillion by 2016. This was the first major blow to trust the U.S. had shown it would devalue its own currency to save its domestic economy. The second and more powerful catalyst was geopolitical. In 2022, following Russia's invasion of Ukraine, the U.S. and its allies did something unprecedented. They froze over $300 billion of Russia's foreign currency reserves. This move weaponized the global financial system. It sent a clear and terrifying message to every other nation. Your dollar reserves are not your money. They are held at the permission of the U.S. government. For countries like China, Saudi Arabia, or India, this was a wake-up call. Relying on the dollar was no longer just an economic risk. It was a geopolitical one. This brings us to today, and the accelerating cracks in the dollar's foundation. The de-dollarization trend is no longer a theory, it's happening. The BRICS economic bloc, Brazil, Russia, India, China, and South Africa, is at the center. In 2024, the bloc expanded, adding major oil producers like Saudi Arabia and the UAE, alongside Egypt, Iran, and Ethiopia. This new bloc now represents 45% of the global population and over 35% of global GDP. And they are actively building alternatives. China and Russia now conduct over 70% of their trade in yuan and rubles. In 2023, Brazil and China struck a deal to trade in their own currencies, bypassing the dollar entirely. India is paying for Russian oil in rupees and UAE dirhams. Even Saudi Arabia is now openly stating it is willing to accept other currencies for its oil, a direct shot at the 1973 petrodollar deal. The dollar's share of global foreign exchange reserves has dropped. In 2001, it accounted for 73% of all central bank reserves. By 2023, that figure had fallen to 58%. That's a 20% decline in 2 decades, and the pace is accelerating. So, where is this money going? Gold. In 2022, central banks purchased 1,078 metric tons of gold. This was the highest level in 55 years since before the Nixon shock. The buying surge continued in 2023, with another 1,037 tons. Who is buying? The central banks of China, Poland, Turkey, and Singapore are leading the pack. These are not minor adjustments. They are a fundamental shift away from dollar-denominated assets like U.S. Treasury bonds to a neutral physical asset that no one can sanction or devalue. They are hedging their bets. Meanwhile, the U.S. national debt now exceeds $34 trillion. The annual interest payment on that debt alone is over $1 trillion. That is more than the entire U.S. defense budget. The political polarization in Washington makes any serious plan to tackle this debt seem impossible. Which brings us back to the historical pattern: Portugal, Spain, the Netherlands, Britain. Each rose, dominated for 80 to 150 years, and then gave way. Their decline was always triggered by the same factors: massive debt, usually from wars, overextension of their military, and the rise of a new economic competitor. America today faces $34 trillion in debt. It's engaged in proxy conflicts and maintains 750 military bases in 80 countries. And a new economic power, China, is building a rival system. The dollar's reign has lasted 80 years since Bretton Woods, and 53 years since the Nixon shock. The historical parallels are impossible to ignore. The end of the dollar's reserve status isn't a prediction for next year. It's a process that is already well underway. The question isn't if, but when and how. Will it be a slow, managed transition into a multipolar currency world? Or will it be a sudden, disruptive collapse triggered by a debt crisis or a new conflict? Which outcome do you think is more likely? A controlled descent or a sudden destabilization? Drop your prediction in the comments below and subscribe, because we will revisit this critical question in 2027 to see what has changed.